The following radio program is for informational purposes only and is neither specific nor tailored financial advice to any individual. It is not intended as an offer or solicitation for the purchase or sale of any financial instrument. Always do your own due diligence and consult a financial advisor before making any investments. Investing involves risk, which can result in the loss of any or all principal. Peter Weitz is a registered investment advisor with Fusion Analytics Investment Partners, LLC, an SEC-registered investment advisor, as well as a registered rep with Fusion Analytics Securities, LLC, a FINRA-registered broker-dealer and SIPC member. All views expressed in this program are those of the host or guests and do not reflect the opinions of Fusion Analytics Investment Partners nor its affiliates. Your investments. How secure are you that they are secure? Do you want to know more about investing, retirement, and moving to the next level in business? Welcome to In Black and Weitz, featuring host Peter Weitz. Our program will answer all of the questions about your future and so much more. It's all about smart business and smarter investing. Now, here is your host, Peter Weitz.
Hi, thanks. Welcome back to the program. I'm your host, Peter Weitz. Today we're going to talk specifically about a topic that's going on in the world, and we really want to focus on how it's affecting the Middle East, or not the Middle East, but how it's affecting us here back in the United States. And it focuses on the Middle East. And I think what we're going to do is draw some data from what history has shown us as to what we can expect. So for those that are listening, make sure you tune in and heavily think about this. The topic of today's program is how the turmoil in the Middle East affects the financial markets and affects how we invest here back in the States. So let me give you a brief history. We've known that in the Middle East recently there's a new faction that's come together called ISIS, which stands for the Islamic State of Iraq and Al-Sham. And we know that they have recently been able to overtake two Iraqi cities, Mosul and Tikrit. For those that are paying attention to this, Mosul is about the size of Philadelphia, where their ultimate goal is to work their way down towards the Persian Gulf and towards the city of Baghdad, with the ultimate goal of having the Nation of Islam run what goes on in the Middle East. And that can have a significant impact globally, but in particular economically. And I think that relates to oil. And that literally is what we have for fears here in the United States. So thinking about that and thinking about the economic forces that can determine what happens globally here in the United States, I brought back noted expert Kevin Lane, who has done some research in this arena, and we're going to present some of the findings today. And we're going to draw correlations between what's happened historically in the past when there's been geopolitical forces and other things going on in the world that potentially affect the United States, and what the impact happened, or what the impact was then, and how it's going to actually affect what happens today. So Kevin, welcome back to the program.
Thanks for having me, Peter.
So let's just start out by Kevin, we've identified that there's this big, massive war going on, or almost an insurgents war, with their own people fighting their own people in the Middle East. And just for starters, give me a broad-based view of what that does generically to an economy, or here to the financial markets.
I think the first thing that, people have to understand is when you're running money and as a portfolio manager, you really have to, people are quickly trying to assess what's the conflict, how big it is, how many sort of adjacent countries, economies are going to be affected, drawn into it. And we're talking about obviously two things right now, what's going on in the Middle East and, of course, what's going on with Russia and the Ukraine. And typically, there's a knee-jerk reaction by markets where when you get some sort of conflict, there's an immediate sort of sell-off or reaction to the news. People get nervous. This is going to be bad. Let me take my money out of the market. And as the market starts to sort of fall, it sort of feeds on itself. People see the reaction of the market to the news, see the market going down, and it kind of almost like that old Psychology 101 study of Pavlov's dogs, where you're conditioned to do something when you see another reaction. People see the market going down, and it sort of feeds or sort of confirms the fear they've had that this is going to be a negative event, and they sell. And, what we've seen recently, at least in these incidents of late, the markets actually came off initially, and have since really recovered most, and in the case of the Nasdaq, all of what it lost during the recent sell down. And I think that's the, people have had time to assess these two incidents, these geopolitical events that are going on right now, and saying, while they're going to impact the economies of, the countries that are involved, it's really nothing that's going to disrupt the global economy, at least at this juncture. Hence why I think the market has shaken that off in the near run and really kind of gotten back on track and started moving towards new highs again.
And so you basically think that what's going on here in the United States and what vis-a-vis what's going on in the rest of the world has already been absorbed inside of the market?
To a degree, yeah. I mean, if you want to go back and look at longer dated history, and it's surprising because it's really counterintuitive to what people may expect. When you say, "Oh, there's a war," people are going to say, "Wow, that is going to be awful." But when we look at all wars, and I'm talking like World War II, the Korean War, Vietnam, the Gulf War, when you bring all of those into perspective, the average return for large cap stocks across all those what were considered much larger conflicts that drew in many countries, which were real wars as opposed to isolated events, which while horrific are these were much bigger wars drawing in many countries. The average return for large cap stocks across all those wars that we mentioned, World War II, Korean War, Vietnam War, Gulf War, large cap stocks returned about 10% on average during those periods. Small caps, 11.6%, and bonds about 5.5%. So markets have actually done really well during what would be considered a time you wouldn't expect them to do well. I think the idea is that wars create spending by the countries. They're actually economic drivers, as perverse as that may sound, and that's why I think a lot of times you see markets react positively to these kind of events.
Amazing, because you would almost think the opposite. I mean, I guess when I think about that, it doesn't really have much logic, Kevin. But you would think if there's a war in the Middle East with our reliance on oil, the gas prices would be going up. But we've actually seen a significant drop the other way.
Right, and I think again, it all comes down to having the best intelligence about how these conflicts are going to play out, or handicapping, is this going to be contained or is this going to get much bigger? And, there's research companies that are out there specifically, that handicap, Stratfor, STRATFOR is one of these well-known, it's a global research company, and a lot of money managers pay large sums of money to get their research, and they actually will handicap, with military-grade intelligence and things of that nature, what they believe, this is going to be an isolated event, this is going to be this is going to, become larger, what have you. And, I think people have access to that information. They're looking at this and saying, well, something of the effect of, what's going on in the Middle East and what's going on in, the Ukraine and Russia, that it's really contained, and it's nothing that is going to affect the global markets. And like you said, even the price of oil, which you would expect to, skyrocket during, some sort of outbreak, at least at this point in time, with the information people have been presented, and we always talk about how quick and how fast and information flows these days. People have taken all this aggregate information from well-known sources and well-informed sources, and have at least at this point have said, you know what, this is something that's contained, and we don't think it's going to be a disruption to oil supplies and or global economies at this juncture.
So, that leads me to my next point. The other issue, I guess, that comes up a lot is this flight to what I'm going to call safety, being gold. Everybody seems to want to purchase gold when there's, world crises going on, because I guess it's the only currency, if you will, that everybody can understand its value.
Right.
What do you think in that regard?
Well, I mean, typically, like you said, gold has been a safe haven. A lot of times, Swiss francs have also been a safe haven, given their neutrality and the banking system they have over there. Gold, I think, certainly tends to get a bid during geopolitical events and things of that nature. But gold also has, other things going on in terms of, there was a lot of oversupply during the previous, up until 2013 or so, when gold was, had a secular bull market and was, just in a long uptrend and treated investors well. And then, of course, collapsed, from 2013 to present. I think what you're seeing is that gold is trying to form a bottom for a variety of reasons. Its price, had about a 40% haircut. Maybe the oversupply and capacity issues have been constrained. A lot of people that wanted to sell gold have gotten out of the way, so it stopped going down because the selling pressure died down. But certainly, I think you'll see an extra bid to the gold market as geopolitical tensions rise.
I think that we've been hearing a lot about that buzz, and there's been many published articles with regards to gold as to the place to be, the next place to go, logically.
Well, I think from an asset allocation standpoint, clearly, if you don't have any, precious metals in your portfolio, and from a commodity perspective, typically when, when we like to do asset allocation, we like to have more of an exposure, to a whole broad basket of commodities as opposed to just trying to, pick the one that's going to do better than others, really expose yourself to the whole asset class. But, ironically, precious metals, even outside of gold, I mean, steel had been depressed for a long time. Recently, in some of our private client portfolios, we bought U.S. Steel, which has done really well since we bought it. Nucor made a new 52-week high today. So you're seeing a lot of money tends to rotate, eventually into depressed areas that haven't moved because people are looking for value. People are looking for things that haven't moved. With the stock market having done so well off the 2009 lows, you see a lot of de-risking lately. Junk bonds have had a pretty good sell-off of late. Stocks had a little bit of a correction. And I think you're starting to see some money rotate into areas of the market and commodities and different areas that have been depressed because people, look at it and say, well, after a 40% haircut, a lot of the bad news is discounted into gold. It hasn't participated in the rally. Maybe gold's going to play a little catch-up here. Maybe precious metals, steel, things of that nature that have been out of favor. So I think you're definitely seeing a rotation into things that have been depressed and haven't worked because, typically, those market sectors will come back. And I think people are playing that mean reversion trade, if you will, and gold, I think, will benefit from that as well.
Yeah, and I appreciate that, Kevin. When we get back from the break, we're going to go back in time a little bit and talk about what happened historically when there have been similar headlines. And we're going to do that in just a minute. You're listening to the In Black and Weitz radio program on Voice America Business.
When it comes to business, you'll find the experts here. Voice America Business Network.
ERISA 408B2, fiduciary standards, safe harbor, fidelity bonds, record keepers, discrimination testing. I am so confused.
Does your 401k plan have more questions than answers? Peter Weitz and his team of 401k experts have a solution. Their on-site service model distinguishes them from other service providers, and they are specialists in 401k costs, regulations, and compliance. If your 401k plan has more questions than answers, then contact Peter at 877-945-2888 or email him at peter@inblackandweitz.com.
Climbing Mount Everest is an amazing feat, and many have died trying to do so. However, more people have died descending Mount Everest than in reaching the summit. Part of the problem may be that people are so focused on reaching their objective that they fail to plan appropriately for what they will do or should be prepared for afterward. Similarly, people are so focused on saving for retirement and reaching retirement that they fail to plan appropriately for what they will encounter once they have actually retired. With 1 out of every 4 65-year-olds today living past the age of 90, you may be retired longer than you are actually working. Have you devised a plan, process, and discipline to ensure that you will not run out of money? If you are not sure what to do, then simply contact Peter Weitz and his retirement team at Fusion Analytics. We help manage human emotions using 3 proprietary investment techniques. Our job is to evaluate the forces that the typical investor can't see so that wealth is preserved and not lost. Find out more at inblackandweitz.com. Weitz is spelled W-E-I-T-Z. Email Peter at inblackandweitz.com. In Black and Weitz, we win by not losing.
When it comes to business, you'll find the experts here. Voice America Business Network.
You are listening to In Black and Weitz. To reach Peter Weitz or his guest today, please call 1-866-472-5790. That's 1-866-472-5790. You may also send an email to peter at inblackandweitz.com. Weitz is spelled W-E-I-T-Z. Email Peter at inblackandweitz.com. Now, back to this week's program.
Hi, thanks. Welcome back to the program. I'm your host, Peter Weitz. We're joined today by Kevin Lane, and we are discussing the Middle East and the world crises and the impact that has on the financial markets here in the United States. And I know we spent the first segment talking about, the ISIS insurgency going on in the areas outside of Baghdad, but we're going to focus a little bit now on Russia and the impact on what Putin is doing in Russia and how that's affecting not only the United States, but neighboring countries as well. And Kevin, shed some light on the financial impact of what's happening over in Russia.
Well, I think, what's interesting, if you look at what markets have been sold off the most of late, it's really been the markets in Europe. And the markets in Europe, Europe has a lot of trading with Russia and things of that nature. And the country actually specifically that's gotten hit the most of late is Germany, the German DAX. I don't know off the top of my head what the recent peak to trough correction was, but it was over 10%, closer to like 12%. It's bounced a bit. And I think that goes back to what we were talking about before. How close, the closer proximity you are to, these sort of conflicts, and the more integration your economy has with the countries that are in conflict, the more likelihood that it's going to affect your market, your economy. And clearly, if we were doing, sort of a television program versus a radio show, we'd have a chart up. You could kind of see, the recent sort of waterfall-like decline that we've had in Germany. A real aggressive sell-off, much more pronounced than what we've seen here in the States. And that's because, again, Europe is a trading partner with Russia. Germany is a trading partner with Russia. I would assume also, the Ukraine to a lesser extent. And so therefore, it's impacted their economy a lot more. And that sell-off is what you're seeing is people trying to handicap, okay, based on what's going on, based on the amount of business we may do with these countries that are in conflict, based on the conflict maybe expanding, where should we reprice equities to adjust for that potential risk? And I think that's what you're seeing going on. And the reason we're less affected here is because, clearly we're much more isolated, not only geographically from those conflicts, but also we have a much broader base in terms of our trading partners. We trade with the world. We're not as focused on or concentrated as Europe may be with other trading partners.
talked about that, and that's your point about how there was a peak to trough drop, particularly in the DAX but in the European markets. We've said on previous shows when we were talking about where there is value and upside, we mentioned Europe only because we felt that the European economy lags behind the U.S. economy in the way their cycles work. And while we had this massive run up, that 200% growth in the S&P 500, we haven't necessarily seen that yet in the EFA. And I'm curious as to whether this is still a buying opportunity of the European indices, or you think that this is a potential another correction and a long-term one.
Well, people talk about diversification, and that's certainly having exposure to other countries, other asset classes makes a lot of sense. However, you really prefer to be overweight, obviously, the countries and the markets that are doing better and the economies that are stronger. And, there's a lot of talk recently, that Europe is entering a second recession. Now, that's twofold. So at first, talk of a recession and things going on causes the market to come off, but the backside of that equation is that if Europe starts to slip into another recession, once it does kind of find its bottom, people are going to start focusing not on the recession, and they're going to say, that means European central banks are going to start printing money and doing what our Fed did here to really stimulate the economy. So, because, obviously they can't afford to go into another recession that's prolonged or deep because, let's face it, they barely have come out of a recessionary environment in Europe. They've stabilized a bit. And as you said in the lead-in, they certainly have not had the growth we've had here. Their equity markets have done fairly well, but there's a lot worse unemployment situations, particularly in Spain, and Italy is having more issues recently. We know about what's gone on in Portugal and Greece. Granted, they're smaller economies, but I think at this juncture, I would be a little, I would be definitely underweight or really have not a lot of exposure to European markets, just because I think as we see more economic data come out of European markets, there's probably another leg down in those markets. And then maybe after that next leg down, when you start to read about, how the central banks are going to, induce massive stimulus to support the economies, then that's probably the time to look to get into Europe.
A lot of that is because of what's going on in Russia and the Middle East?
I think that's a factor, that's aggravating the situation, but I think it's really, it's twofold. I think it's primarily just that their economies have not had the recovery we've had. There's structural differences in the way that we work versus the way Europe works in terms of average hours per week worked. The 8 weeks vacation typically that a lot of or 6-7 weeks European workers get. They've really always been more of an economy that's been based on tourism. I mean, outside of course, Germany, which has a much more broad-based, diverse economic infrastructure, and of course, as does Great Britain and things of that nature. But a lot of it is, they've just had these economies that you don't really think of Europe as being the center for high technology. I mean, you think about Silicon Valley in California, even in Boston, the corridor side of 128 that they used to call America's Technology Highway. You think about even Israel has a very high level of high tech economy, and are really at sort of the cutting edge of some of these things. And in the European economy, really, you don't think that the job growth and the growth really is in technology in those areas. You don't really think of Europe as being leaders in those areas. And so I think, to answer your question, maybe 3/4 of it is just the economy is in a malaise. There's some, in Spain, I think the unemployment rate is still like 15 or 16%. And so they've got just different issues that they're not adapting, I believe, as well to this new economy, if you will, than we have in our country. So I think 3/4 of it, the problem is probably just the economy is not as stable there. It's malaise. It's potentially recessionary, a second recession. But given that happening, what's going on in Russia only aggravates that situation because it makes people more concerned, and then capital gets removed from those markets. And as you mentioned before, like a flight to safety probably benefits a market like the U.S. So you get capital outflows out of Europe and areas like that and into places where people think, their capital is safer.
What about as that relates, and just as a follow-on question, if you looked specifically at foreign large cap companies, multinationals that are still doing business, outside of the European markets, I mean, are those still opportunity value plays?
Yeah, I think, clearly, the multinationals are different. We've been talking the last time I was on the program, we talked about how here in the States, small cap stocks have really taken it on the chin more so than large cap. So I think by and large, and that's a really good point you brought up, if you are going to play in Europe for a value play, buying a multinational who's got revenue that's geographically dispersed, meaning, the revenue is coming from all over the globe and they're not just maybe concentrated in certain areas, and larger cap, better balance sheets, things of that nature, better overall values, companies that are able to sort of withstand turbulence more than maybe a small cap issue. I think that's a great point, that if you are going to get some exposure to European stocks that may become more depressed than maybe their U.S. large cap counterparts, given the European economy's weakness, certainly playing a lot of the multinational ADRs would make a lot of sense.
I tend to agree with that. We did this whole dividend play here in the U.S. and several years ago and bought stocks that, maintained a large dividend or kept the dividend the same for a period of time, sort of this aristocrat kind of thought process. And it seemed to hold its own even when there were small dips in the economy. I'm wondering if that, similar type strategy. I know this, a lot of our listeners have such a large exposure to international, or at least have exposure to international. I'm looking for a way that they can stay in there without potentially really hurting their portfolio.
Yeah, and I think again, large caps by and large, when you go down the, the risk spectrum, you put junk bonds, at the highest level of risk, and then, you've got from an equity standpoint, micro caps and then small caps, and you start to go up the cap spectrum. And of course, because these large cap companies typically are, cash cows with lots of cash in the books. And so if things, start to sort of get unsettled, from a stock perspective, large caps are considered, the more safer environment. And of course, large caps that pay dividends would be, of course, considered even safer again. So, from a risk to safety spectrum, if you are going to be in those markets, clearly, going larger cap, I think provides you a level of safety relative to small and micro cap stocks. And, of course, equities are going to be obviously more volatile than fixed income classes to begin with, but within the equity spectrum, large caps and mega caps should, in theory, hold up better during corrective periods than their peers.
And I appreciate that, Kevin. When we get back, we're going to continue this discussion on the world affairs and the markets and how they affect us here in the United States. We're going to do that in just a minute. You're listening to the In Black and Weitz radio program on Voice America Business.
From the boardroom to you, Voice America Business Network.
Climbing Mount Everest is an amazing feat, and many have died trying to do so. However, more people have died descending Mount Everest than in reaching the summit. Part of the problem may be that people are so focused on reaching their objective that they fail to plan appropriately for what they will do or should be prepared for afterward. Similarly, people are so focused on saving for retirement and reaching retirement that they fail to plan appropriately for what they will encounter once they have actually retired. With 1 out of every 4 65-year-olds today living past the age of 90, you may be retired longer than you are actually working. Have you devised a plan, process, and discipline to ensure that you will not run out of money? If you are not sure what to do, then simply contact Peter Weitz and his retirement team at Fusion Analytics. We help manage human emotions using 3 proprietary investment techniques. Our job is to evaluate the forces that the typical investor can't see so that wealth is preserved and not lost. Find out more at inblackandweitz.com. Weitz is spelled Weitz. Email Peter at inblackandweitz.com. In Black and Weitz, we win by not losing.
ERISA 408B2, fiduciary standards, safe harbor, fidelity bonds, record keepers, discrimination testing. I am so confused.
Does your 401k plan have more questions than answers? Peter Weitz and his team of 401k experts have a solution. Their on-site service model distinguishes them from other service providers, and they are specialists in 401k costs, regulations, and compliance. If your 401k plan has more questions than answers, then contact Peter at 877-945-2888 or email him at peter@inblackandweitz.com.
Voice America Business Network, the bottom line in business.
You are listening to In Black and Weitz. To reach Peter Weitz or his guest today, please call 1-866-472-5790. That's 1-866-472-5790. You may also send an email to peter@inblackandweitz.com. Weitz is spelled Weitz. Email Peter at inblackandweitz.com. Now, back to this week's program.
Hi, thanks. Welcome back to the program. We're joined today by Kevin Lane, noted industry expert and financial expert. We were talking about the global impact of world affairs and the effects that it potentially has on the United States. And during the break, Kevin made an interesting point about wars these days. And as morbid of a topic as it is, it doesn't require the manpower that it once did because of technology. And here it is, we're talking about advancements in business and advancements in the world, and yet we're able to use those for war. But Kevin, expand on what you meant by that.
Well, we were talking about economic impact, and, there used to be an old saying back in, World War II and, in the Korean War and different things that would say, with the stock market adage that you buy when the bombs start dropping and you sell when the boys come home, meaning when the troops come home. And the idea behind that was, because governments, in this case the U.S., years ago, government spending would skyrocket because they had to amp up for war, planes, tanks, which would then, that means steel and other things needed for all these things that they needed to ramp up for. That meant hiring new people at factories to, that were creating the planes and the tanks and the armored shields and what have you. And so that's why when we talked about it being perverse, kind of that, well, you would think off, common sense, if there's a war, it was going to be horrible for stocks. But in fact, back in the day, it was actually beneficial for stocks because government spending just went through the roof and hiring related to things that were needed for supplies for the war. I mean, food, shipments, supplies, planes, everything to support that war effort was a really positive for the domestic economy. But, as we talked about kind of on the break, nowadays wars are fought very different, with drones and, things of that nature that, there's a lot less manpower and effort. The way technology is sort of made news instantaneous through Twitter and things of that nature, it's really changed the landscape of war in terms of, I think with things like, we were talking about ISIS earlier, and, they can get in there with Predator drones and make targeted strikes, and you're talking about, not to oversimplify it, but you're talking about somebody sitting in a room, maybe in Langley, Virginia, with a joystick, controlling a drone versus years ago that would have been, okay, we got to deploy, 1,000 troops to go after this, small group of insurgents. Nowadays, they can get a couple drones up in the air and take them out. So, I mean, the economic drain that sometimes can come from a prolonged war is probably, not as big as it used to be years ago. Like we said in the beginning, the amping up for the war was a stimulus, but eventually the longer duration of these sort of wars can be a drag economically because, the longer they draw out, then it does eventually, draw funds away from the real economy. But I think nowadays, it's sad. It's a sad thing to say, but war has gone 21st century as well. And I think, therefore, the dislocations to the economy, you're not pulling, men out of the labor force that are, part of the military through the reserves and things of that nature. And so there's less impact on the economy nowadays, for wars versus I think in the past.
Yeah, and that's it's a pretty wild thing to think about because technology is really almost an encouragement towards war. But it's just an interesting concept.
And then the other thing, you never like to think about, well, who benefits during these things, but from an investment standpoint, you kind of, what companies in this kind of new age we're in to do well. And, the one name that sort of comes to mind could be, in full disclosure on this, we don't own any fusion accounts as well in terms of accounts. The name that comes to my mind symbol AV, and they make, a lot of the drone technology and things like that. So, there's always that angle, and you're not trying to say, well, I want to make money off of, bloodshed, if you will, but trying to take that tact of, well, what companies are involved sort of, in the space that are providing maybe the technology for these new kind of things. And a lot of this stuff, isn't necessarily, drones that are there for the purpose of taking down insurgents or whatever. I mean, a lot of these are, reconnaissance drones that are put up there to sort of, gain insight. So it's not always, necessarily a drone that's armed, but one name that comes to my mind thinking like, if you are going to try to say, well, what are the impacts of the economy, but are there any stocks that, may benefit from sort of this new age of military technology? And that's certainly one of the names that comes to my mind.
And Kevin, repeat that name again. It was a little fuzzy when you said it, but the company.
Sure. The name of the company is Aero, AERO, Environment, VIRONMENT. The symbol is Apple Victor, and they make a lot of the drone technology.
Yeah. So I guess that's going to lead me into this question, Kevin. Is that all right? So now you poo-pooed Europe, right? You don't necessarily feel there's value in gold, although some other precious metals, there might be some opportunity, and you've started to take advantage of that, particularly in steel. You're not high on Germany. So you mentioned one company. I mean, where can we find opportunity in the markets if we just think in terms of this, geopolitical warfare going on? Where do we find other opportunity?
Sure. Well, I think, framing this, whole conversation, you have to, look at where we are, where we've come from. And, I think we had done a piece on the, that the S&P 500's enterprise value to its EBITDA ratio for all 500 companies, rolling off as an aggregate, is a little over where it was in 2000, and it's just shy 2000 internet bubble peak for the S&P 500 companies. So clearly, there's less and less opportunities to find, A, because some of the geopolitical events, B, because maybe Europe is a bit softer, C, because maybe now the U.S. is starting to move into a bit of where stocks aren't undervalued anymore, they're probably not fair value. They're probably slightly above fair value, kind of in between fair value and overvalued. So it really becomes hard, and I think that's why you're seeing some of the rotation to these down and out sectors. You know, investors are saying, hey, you know, do I want to, you know, stretch with new money to buy a company that's trading at X times its enterprise value to EBITDA, which may be towards the historical high end for an S&P 500 company, or would I prefer to take a shot on gold that's down, you know, 35-40% from its peak, or steel, which has been obliterated, or even coal for that matter. So I think that's why you're starting to see some of these out of favor sectors that have been unloved, if you will, but have discounted a lot of bad news. Remember, the market is a discounting mechanism. It takes all the known information and it aggregates it with everybody's opinion and says, hey, based on everything we can kind of foresee into the relatively near future, this is good or this is bad. So at gold at these levels, steel at these levels, see these sectors that have kind of had bigger corrections, a lot of the risk, at least theoretically, has been wrung out of them. And I think if you're looking for, you know, to put new money to work, I think that's where you kind of have to start to look. I mean, and interestingly enough, another area is maybe, you know, playing China. Now, I know people have talked about China for a long time and what have you, but the Hang Seng Index has actually been under pressure for about the last 5 or 6 years in terms of going down. But it's finally kind of started to turn the corner here. And I think if I was looking for some new money to put to work, because China looks like it's going to undergo some sort of bigger stimulus program to kind of get the economy juicing again, like we did here in the U.S. with QE and the quantitative easing. So I was looking for some new money, you know, maybe having a little exposure to gold, having a little exposure to the steel sector, having definitely maybe some exposure to China, which could finally be turning the corner here. I think those are areas to, you know, put your money.
We're going to do this in just a couple minutes, Cameron. We're going to finish up this topic, and we'll be back in just a minute or two. You're listening to the In Black and Weitz radio program on Voice America Business.
Voice America Business Network, the bottom line in business.
ERISA 408B2, fiduciary standards, safe harbor, fidelity bonds, record keepers, discrimination testing. I am so confused.
Does your 401k plan have more questions than answers? Peter Weitz and his team of 401k experts have a solution. Their on-site service model distinguishes them from other service providers, and they are specialists in 401k costs, regulations, and compliance. If your 401k plan has more questions than answers, then contact Peter at 877-945-2888 or email him at peter@inblackandweitz.com.
Climbing Mount Everest is an amazing feat, and many have died trying to do so. However, more people have died descending Mount Everest than in reaching the summit. Part of the problem may be that people are so focused on reaching their objective that they fail to plan appropriately for what they will do or should be prepared for afterward. Similarly, people are so focused on saving for retirement and reaching retirement that they fail to plan appropriately for what they will encounter once they have actually retired. With 1 out of every 4 65-year-olds today living past the age of 90, you may be retired longer than you are actually working. Have you devised a plan, process, and discipline to ensure that you will not run out of money? If you are not sure what to do, then simply contact Peter Weitz and his retirement team at Fusion Analytics. We help manage human emotions using 3 proprietary investment techniques. Our job is to evaluate the forces that the typical investor can't see so that wealth is preserved and not lost. Find out more at inblackandweitz.com. Weitz is spelled W-E-I-T-Z. Email Peter at inblackandweitz.com. In Black and Weitz, we win by not losing.
The business community's first choice in Internet Talk Radio. Voice America Business Network.
You are listening to In Black and Weitz. To reach Peter Weitz or his guest today, please call 1-866-472-5790. That's 1-866-472-5790. You may also send an email to peter@inblackandweitz.com. Weitz is spelled W-E-I-T-Z. Email Peter at inblackandweitz.com. Now, back to this week's program.
Hi, thanks. Welcome back to the program. We've spent the vast majority of the show talking about what's been going on in the world and how it affects the financial markets, particularly here in the United States. But I think I want to end the show with, sort of what we can do as investors, or, for that matter, what we shouldn't do as investors. And, Kevin, I follow your strategy, your long sword strategy pretty intently. And I've noticed that lately there's been a pretty good flee to cash. And I'm wondering if that has anything to do with what's going on in the world.
Well, I think it's, several different things. We had talked about how, stocks, at least even domestically here, and I know that, there could be arguments for pros and cons on both sides that would probably sound plausible. But we've started to see, valuations start to get stretched a little in terms of where we are on a historical basis. We've seen the Russell start to dramatically underperform. We've seen junk bonds, they've come off pretty aggressively. Granted, they've bounced recently the last 3 or 4 sessions, but if you're reading the tea leaves of the market, as they say, the market seems to be trying to take risk off, getting out of riskier asset classes. And typically, when you see this sort of systematic de-risking, it's usually an early indication that, maybe you're headed for some trouble. Astute investors, ride the riskier assets because they tend to perform better when the market's moving up. As those riskier assets start to break down, it's typically a suggestion that people are becoming uncomfortable, even given the potential for outsized returns in riskier assets. So they start to take those off the table first, and there's a rotation into, less riskier assets. And that usually is a path or process that you see ahead of a correction. The risk assets get hit. More money flows into the more stable assets. The more stable assets tend to rise to a level that may make them historically, rich in terms of valuation. Then they start coming off, and then everything starts to come off. So we're starting to see that, and this is a hard thing for people to understand sometimes, and I talk about this all the time, even with other professional peers. Sometimes the best trade, as they say in the business, is no trade. Sometimes, people always feel like, I need to be invested, or, you don't always have to be 100% invested. Sometimes you can kind of raise some cash, step back, and as I like to say, let the dust settle, and then determine, non-emotionally, is the evidence overwhelmingly supportive or overwhelmingly negative? And if it's overwhelmingly supportive, you can get more to a fully invested state. If it's overwhelmingly negative, you continue to raise more cash and, maybe get out of the way of things. And I think we're starting to see that pro-con ledger sort of even out, and that's why we've, raised a bit of cash. The beauty of markets nowadays with ETFs is if you do raise a bit of cash and then you decide something has changed, the market ETFs like the Qs and the spiders, for the S&P, and the Qs for technology, they're so liquid. You could have a high level of cash and almost within seconds go to fully invested by giving yourself market exposure through these ETFs. So sometimes I think it pays just to step back, let the dust settle, see how things play out until you get more of an all-clear signal. And like I always say, if the market is potentially going to run up another 20%, missing the first 3 or 4% to be more certain and more, likely that you're correct in reallocating back into it, I think makes sense.
You mentioned that you sit on the sidelines and, you wait for that change, that run up again. I mean, what is a signal to an investor that the dust has settled?
Well, that's a great question. One of the things we like to do is look under the surface of the market. We don't care about whether we're up 300 points, down 300 points. What's going on underneath the surface? How many stocks are participating in the rally? As the saying goes, it's strength in numbers. So if more stocks are making new highs and new lows, that's a positive. That means there are more stocks running up with the market than a select few. Because if it's a select few, eventually the select few run out of gas and, the advance will lose steam. So we like to look at how many stocks are advancing versus declining on a given basis. How many stocks are making new highs versus new lows? We call those conditional elements. It would be like hooking your car up, to the, in the garage and having the diagnostics checked, or, going to the doctor and having him run you through blood work, x-rays. And you start to see under the surface, because a lot of times things can look good, and then as you get under the hood, you're like, oh wow, you really can't judge a book by the cover because the book looks good, but then when you get under the hood, it doesn't look as good. So we start to look at that, and that's another reason of late we've started to raise some cash is, that less and less stocks have been participating in the rally. Like we mentioned, risk assets have been doing poorly. So there's certain signs, but for us to re-engage that cash portion and go back into equities, it could take a correction to lower valuation. It could take just seeing more new highs, more stocks going up and down on a regular basis, more volume going in on upticks versus downticks. That means buyers are impatient and they're buying stocks as they tick up, not waiting for them to come in. So there's sort of an aggression on the buyer's side versus the seller's side. And then looking at global markets as well, too, because, if you look at the last 3 weeks when markets corrected, it wasn't like just, okay, one market corrected. It kind of has this ripple effect since we're so interconnected now. Different markets corrected at different depths. But when the U.S. was getting hit, Germany was getting hit. When Germany was getting hit, Russia was getting hit. When Russia was getting hit, Brazil was getting hit. So, all the markets kind of ebb and flow together. So then you also look at, how many markets are rising and falling together. And those are good indications. The rising tide lifts all boats. And when more stocks are doing well, that suggests, there's a lot of money flowing into equities, and you then want to ride that.
Quite there yet is what you're saying.
Right. When you had the kind of sell-off and deterioration we had recently, even though the NASDAQ has regained its sort of peak and things of that nature, but if you look at that NASDAQ coming back to new highs, the majority of the gain in even in NASDAQ has been really the biotech stocks. So, yeah, we definitely need to see a broader representation of stocks doing well.
Yeah, and so obviously, but there's value in specific sectors. You just have to be, or specific stocks. You just have to be an expert to find those.
Right, and as you mentioned on the earlier, with the S&P from the 09 lows to present being up close to 200% or whatever the exact number is, it's a lot harder to find value than it was in 2010, 2011, 2013, because the earnings multiples or other valuation metrics are a lot richer than they were. There's less stocks that are fair value or under fair value than there were 2 years ago, 3 years ago, 4 years ago, 5 years ago.
To end there, Kevin, I think that your points are well taken, that what's going on in the rest of the world's already been reflected as to what's going on here domestically, and that really what's going on in the European markets is more of a symptom of poor conditions in the European markets and in their economies than necessarily what's going on in the rest of the world.
Right, exactly. And I think the geopolitical things are something, of course, that are newsworthy, and it gives investors, the news media always likes to have a plausible explanation. Oh, the market went down. It's not the market went down just because there were more sellers than buyers. They have to explain why. People want a rationale. Oh, it's because of, the geopolitical uprisings. And that may or may not be the case. And I think, what we're talking about, it's probably more likely just that some of the economies are weakening than it is these geopolitical events.
Yeah, and I totally appreciate that. Kevin, thanks as always for being on the program.
Appreciate it. Thanks, Peter.
Next week, Kevin, I know you'll want to listen. We're actually going to have a show related to the art of wine and wine drinking and how that's become such a big business here in the United States. And I've got a expert sommelier who's going to discuss the impact of wine on the economy and on the business world as a whole. So make sure you tune in. Thanks again to Kevin Lane for being on this week's program. It's always a pleasure to speak with him and learn more about what's going on in the world and the markets. It's been a great program. I'm your host, Peter Weitz. You're listening to the In Black and Weitz radio program on Voice America Business. Make it a great week.
Thank you again for tuning in to In Black and Weitz. Please join your host, Peter Weitz, again next Tuesday at 10 a.m. Eastern Time and 7 a.m. Pacific Time for another edition of the program on the Voice America Business Channel. Have a safe week.